Welcome to the deep dive. Today we're really digging into a major corporate event, the collapse of Fiserv, Inc., ticker FI. Our goal here is to cut through the noise, the sheer financial chaos, and give you some clarity. We're zooming in on one specific day, October 29th, 2025. You could call it Fiserv's day of reckoning. Yeah, the stock just cratered, over 41% down in a single day. It went from, what, about $126 down to roughly $73 at the close. We're talking tens of billions of dollars in market value. Poof, gone. So the big question that we have to tackle is this. Is a drop like that a sign the company is fundamentally broken, structurally damaged? Or is this sheer market panic actually creating maybe the buying opportunity of a generation for investors who can stomach the volatility?
And that's exactly the lens we'll use, a value investing framework. We need to look at the stark new reality for Fiserv, get past the initial shock, and figure out its actual worth. And just to give you a heads up on where we land, our educational analysis points to an intrinsic value somewhere between $95 and $115 per share.
Okay, so if that's right, $73 is foul. Well, that's a massive discount.
A shocking discount, potentially. That's the gap. That's the disconnect we really need to unpack for you over the next few minutes.
All right, let's get straight into it. Let's look at the anatomy of this disaster. Okay, first off, let's understand the core business here.
Chapter 1. Business analysis.
Right, so Fiserv. To really grasp how big this fall was, you need to appreciate the scale we're talking about. This is a global giant. People often call it the essential plumbing for commerce today. They process something like 850 million transactions every single day. They're deeply embedded.
And that embedding is crucial because the root of the problem lies in how that business is split. They essentially have two main parts. Now, the clear strength, the bit everyone likes, that's the merchant solutions segment. That's where they handle payments, transaction fees, and especially their Clover point-of-sale terminals. That's the crown jewel.
Right, the Clover systems. You see them everywhere.
Exactly. And that segment, even in that disastrous Q3 2025, it actually posted decent 5% organic revenue growth. So that part was still working.
So Clover's the future, but the problems came from the legacy side.
Precisely. The financial solutions segment. This is the part that provides core account processing for banks, for credit unions. That was the absolute epicenter of the troubles. That segment reported a really concerning 3% year-over-year decline in organic revenue.
Wow, a decline. For a tech company like this, that's not good.
It's almost unthinkable. It signals a major issue.
So why the decline there? You mentioned this whole industry is shifting, fast AI, embedded finance, real-time payments. What specifically pushed banks away from that core business so quickly?
It's just relentless pressure from technology accelerating everything digital.
Yeah.
You got AI exploding in finance. It was a $30 billion market in 2025, expected to nearly triple by 2030.
But you also mentioned FIDA. That's key. FIDA, the Financial Data Access Framework, it started in Europe, but it's setting the global standard for open finance now.
Okay, FIDA. And open finance. That basically means consumers control their data more. Let third parties access it. Exactly. FIDA mandates that consumers can securely share their financial data with third-party providers. Think fintech apps, budget tools, things like that.
So that makes it easier for newer, nimbler fintech companies to just plug services directly into a customer's financial life, kind of bypassing Fiserv's old systems.
You got it. It forces speed, integration, transparency. And Fiserv, they just realized too late they'd fallen behind on that critical shift. Now, even with that stumble, they do still have some strong competitive advantages, those moats. Primarily, the high switching costs for banks changing a core system takes years. It's a huge undertaking.
And the Clover network effect, I imagine. More merchants use it, more apps get built for it.
Definitely. The Clover app market has a powerful network effect. But it's telling that the company's own recovery plan, the One Fiserv plan.
Yeah, they announced that right alongside the bad news.
Right. And it explicitly aimed at building up Clover and finally embracing AI and embedded finance. It's basically a direct public admission saying, oops, we fell behind, we didn't execute.
A public mea culpa, which naturally leads to questions about the leadership who let that happen.
And that failure of execution takes us straight to the breakdown in trust with management.
Let's talk about that executive response, or maybe the lack thereof, until it was too late.
Chapter 2, Management Evaluation. Well, the first sign something was deeply wrong internally was the immediate, almost surgical leadership overhaul on October 29th. It felt premeditated. The new CEO, Mike Lyons, he'd only been there since May 2025. He led this whole restructuring.
So new blood at the top. Who else came in?
They brought in some heavy hitters, a new CFO, Paul Todd, poached from a competitor, Global Payments, and a new co-president, Divya Suryavara, she has an incredible background. United Health, Stripe, GM.
Okay, so a qualified team seemingly brought in to fix things, but the real damage wasn't about the new faces, it was the credibility destroyed by the old ones, right?
Absolutely devastating. Just think, 3 months earlier, in Q2, the old management was projecting strong, 10% organic revenue growth. They guided EPS to $10.1530.
And then October 29th happened?
They completely obliterated that guidance. Slashed revenue growth expectations by more than half, down to just 3.5% to 4%. And EPS guidance chopped down to $8.50, $8.60.
How does a company even recover from that, especially in fintech, where trust is everything? That's not just missing estimates, it's like admitting you didn't even understand your own business 3 months earlier.
That's the heart of it.
Yeah.
CEO Lyons tried to frame it as a kitchen sink quarter. He basically said the old guidance was based on unrealistic assumptions.
Throwing the old team under the bus?
Completely. Which means the market now has absolutely zero reason to trust any forward-looking statement from Fiserv. The new team can talk all they want. Their entire future depends on execution, pure and simple. Actions, not words.
And adding insult to injury here is the whole capital allocation story. Pfizer was buying back shares like crazy.
Aggressively. $29 billion returned over 10 years, almost all through buybacks, no cash dividend. And in just the first 9 months of 2025, they spent $5.4 billion on buybacks.
Buying their own stock at what prices?
That's the staggering part. They were buying shares at prices as high as $238.59 earlier in the year. Then the stock crashes to $73.
Ouch. So they effectively burned billions of shareholder money buying high.
It's permanent value destruction on a massive scale. Billions gone. It's no wonder the new CFO's very first mandate is explicitly disciplined capital allocation.
So you have squandered capital, leadership that seemed blind. It paints a pretty bleak picture leading up to the crash. Okay, we've covered the business flaws, the leadership crisis. Let's pause quickly before we dive into the financials themselves. Just a reminder, like and subscribe to the Stock Analytics AI YouTube channel. And remember, members can suggest stocks for future deep dives right in the comments. We do pick those up. For $4.99 a month, you get access to our playlist of 500 deep dives on S&P 500 stocks. And coming up next, exclusively for members, we're tackling the NASDAQ 100.
All right, we understand the why. Now let's get past the crisis narrative and really look at the numbers.
Chapter 3, Financial Analysis. Okay, the market cap hit was huge, $29 billion wiped out in a day. Left the company valued around $39 billion. But what about the underlying operations? The profitability?
Yeah, the pressure there is profound. The Q3 adjusted operating margin, it compressed significantly, down to 37.0% from 40.2% the year before.
Meaning costs are rising faster than revenue.
Exactly. The opposite of what you want in a scale tech business. But the biggest red flag for us, the one that really makes you worry, is the free cash flow.
Right. Cash is king. What happened there?
It showed a really worrying decline. In the first 9 months of 2024, they generated about $3.34 billion in free cash flow. Same period in 2025, only $2.88 billion.
So that drop tells you the problems in financial solutions aren't just on paper. They're actually eating into the real cash the business generates.
Precisely. And then you had that Q3 adjusted EPS number, $2.04. It came in a shocking 22.27% below what analysts expected. That just shattered their long-held reputation for being predictable, reliable.
And the market's reaction was to totally reprice the company.
Completely rewrote the script. Before the crash, the price-to-earnings ratio was near 21. After the crash, it collapsed to about 12.06.
12. For Fiserv, their historical average was much higher, wasn't it?
Way higher. Historically, they traded at an average PE of almost 39. So the market went from valuing it as a high-growth fintech leader to valuing it like a slow-growth industrial firm, a railroad or something.
That drastic change forces us to step back and try to calculate its actual intrinsic valuation, separate from the panic.
Exactly. We use our discounted cash flow model, basically summing up all the estimated future cash flows and discounting them back to today's value. But our inputs have to reflect this new, much riskier reality. So we use the company's new lower growth guidance, that 3.5% to 4%. And crucially, we have to use a much higher discount rate, the WACC.
Okay, the WACC weighted average cost of capital. Just quickly, why does that have to be higher now?
Good question. The WACC reflects the return investors' demand for the risk they're taking. After this credibility crisis, the execution mess, the sheer volatility, the risk profile of Fiserv shot way up.
Makes sense. More risk, investors want more potential return.
Exactly. So they demand a higher return to compensate. That's why we conservatively estimate the WACC now between 8.5% and 9.5%, reflecting that increased risk.
Okay, so low growth, Higher discount rate. What does the model spit out?
The result, for educational purposes, is an estimated intrinsic value range of $95 to $115 per share.
95 to 115. Compared to the current price around $73, that's a very wide gap.
It's stark. It tells you the market is pricing in a lot of negativity right now.
All right, let's shift gears. Why did the market react so violently? Was it just the earnings miss?
Chapter 4, Market Sentiment. Well, what's really striking is that almost nobody saw this magnitude of a disaster coming. If you look at the short interest data before the crash,
People betting against the stock.
right, it was tiny. Only 1.42% of the shares were shorted. That's well below the average for similar companies, which is closer to 5%.
So this wasn't a situation where bears were circling for months. It was a surprise.
A genuine black swan event. The crash seems to have been driven more by shock, by forced selling, rather than a long-developing negative view.
And the technical chart damage must be severe.
Oh, profound. The stock is trading something like 58% below its 200-day moving average. That's a key long-term trend indicator, and it signals a really deeply negative trend now.
Wall Street analysts were surprised too.
Caught completely flat-footed. You had analysts, I think it was Jefferies, publicly saying the size of the miss was just difficult to comprehend. They were blindsided.
Let's talk about that forced selling you mentioned. Who was forced to sell?
Chapter 5, Ownership Structure.
Okay, ownership. The outline notes over 91% of Fiserv is owned by institutions. Big funds like Vanguard, BlackRock. How did that high concentration make the crash worse?
It boils down to passive index funds. Think about the S&P 500.
The Fiserv is in the S&P 500.
Right. So when its market value plummeted by $29 billion overnight, its weighting, its percentage share within the S&P 500 automatically dropped. Now, those big passive index funds, their whole job is to perfectly mirror the index. So if Fiserv's weight drops, they have to sell shares to match that new lower weight.
So they weren't selling because they thought Fiserv was suddenly a bad company. They were selling because their rules forced them to, mechanically, regardless of the price.
Precisely. It becomes a forced liquidation, accelerating the downward spiral. They're sellers out of necessity, not because they made a strategic decision about the stock's value at 73 threels.
That makes sense. What about insiders, executives, directors?
Well, that adds another layer of concern. Insider ownership is actually quite low, only 0.7%. And leading up to the crash, the pattern was pretty telling. You saw consistent insider selling and, crucially, a complete absence of any open market purchases by executives or directors in the prior 12 months.
No one was buying, even when the stock was higher.
No one. In fact, you even had the former chairman selling $8.1 million worth of stock at $202 per share not long before. It suggests, the people who knew the company best didn't seem to have much conviction in that high valuation.
Yeah, that lack of insider buying ahead of a crash is not a great signal. Okay, let's look at the risks going forward and maybe the opportunities too.
Chapter 6, Risk Assessment. So despite all this internal chaos, we have to remember the strengths that are still there. Market leadership in many areas, those high switching costs we talked about, and the Clover ecosystem.
The moat is damaged, but maybe not destroyed.
Potentially. The moat is still theoretically intact. The critical weaknesses, though, are clearly internal now. That complete loss of management credibility and just profound execution failures.
But there's also an external risk highlighted here. The idea of potential U.S. tariffs in 2025 on electronic goods. Why is that specific risk so important for Fiserv's recovery?
It's critical because it directly threatens their main growth engine, which is Clover.
Because the hardware comes from Asia.
Exactly. Those Clover point-of-sale terminals rely heavily on hardware sourced from Asia. If significant tariffs were imposed, the new management team faces a really nasty dilemma immediately. They'd either have to absorb those extra costs themselves, which would squeeze margins even further in the merchant solutions segment.
Hurting profitability just when they need to show improvement.
Right. Or they pass the costs on to the merchants buying the terminals. But if they do that, it likely slows down Clover adoption, slows down growth, precisely when they need to accelerate it to prove the turnaround is real. It's a tough spot.
Yeah, it kind of traps them. Makes executing that one Fiserv plan much harder without taking an immediate financial hit.
It does. On the flip side, the opportunity here is that this massive valuation reset could act as a margin of safety for new investors. If, and it's a big if, this new management team can actually deliver on AI-driven efficiencies and successfully expand into embedded finance.
Okay, that brings us to the final synthesis, pulling it all together.
Chapter 7, Conclusion.
So let's lay out the two sides. The bull case here basically says, look, the crash was a massive overreaction. Panic, forced selling drove the price way too low. The argument being the long-term advantages, the moat, it's still there. The new management team looks decisive. They look qualified. And a PE ratio of 12 for a company of this scale and market position, that's just historically cheap.
That's the bull argument. But the bear case shouts value trap loudly. They argue this collapse isn't just a blip, it's a symptom of deep systemic problems, a fundamental lack of visibility into their own business. The bears would say intense competition, plus the company's significant debt load could lead to years of stagnation, just muddling through. That low price might stay low for a long, long time.
So we circle back to our finding. The current share price, around $73, is sitting significantly below our educational intrinsic value estimate of $95 to $115 per share.
And that very wide gap tells you the market is pricing in extreme pessimism right now. Maybe it's assuming Fiserv becomes a perpetually slow-growth company. Ultimately, the investment decision today seems to hinge almost entirely on faith. Faith in this new management team. Can they execute? Can they actually deliver a successful turnaround? Can they restore discipline? And maybe most importantly, can they rebuild trust after such a monumental failure?
A really tough call for investors right now. So here's a final thought for you to consider. Given those extreme execution failures that caused this crisis, what's one specific measurable action this new management team needs to take, say, in the next 90 days, to actually prove to the market that their one Fiserv plan is credible and the turnaround is real? What would convince you? Something to think about. Thanks for joining us for this deep dive. Remember to like and subscribe to Stock Analytics AI and drop those stock requests for future deep dives in the comments. We do check them.
And the necessary reminder. This analysis was generated by an AI system for educational purposes only. It should not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.